Hello, everybody, and welcome to this week's Nasdaq Dorsey Wright podcast. Today is April the 12th, and I'm Jay Greg Nanny. Here joining me this week is Ian Saunders. And Ian, it's coming off of a weekend that I know many of us, at least in the Richmond area, many around the world this year, took interest in the Masters that was just recently completed and finished up last year, having seen a first, and that is, seeing a Japanese golfer win the tournament this year. So it's interesting, getting back to normal in terms of time of year. We were just talking how there's been two Masters played in a very short order, one back in November and one just now wrapping up this weekend.
Certainly, it was definitely pretty cool to see golf continue to expand globally, I guess, with the first Japanese champion ever. But yeah, definitely nice to see all the flowers bloom this go around, which we didn't get quite to see there in November. So
a little bit different experience, but as we move forward through 2021, I mean, geez, it's hard to believe that we're talking about the Masters, that it's April, and that the first quarter of the market is in the books this year. And there's been a lot, as there were changes and have continued to be changes as we move through the past year of the COVID pandemic, and as we continue to operate around that. There's been a lot of changes in the way that we do business. There's been a change in a lot of ways that people interact on a daily basis and move through life these days. And that certainly held true for the market as we look back on the first quarter of 2021. And there were a lot of changes that we saw unfold after coming into this year. One of the big trends that has been in place for quite some time now is the fact that U.S. equities remain the strongest within our asset class ranking tool, that being Dolly, the strongest area. But Ian, underneath the surface, I mean, there was just a ton of changes, a ton of rotation happening in terms of the leadership positions.
Absolutely. I mean, as we wrap up the first 3 months of the year, we have a variety of quarterly updates and kind of updates to where strength lies kind of at 4 different points throughout the years. And those have been through in our research report throughout the course of the past week or so. And one of those that I think is pretty helpful to look at from a visual perspective is what we call the smart beta quilt, or the US smart beta quilt, which is essentially looking at a variety of representatives, generally from a factor perspective, for where strength is on the market based upon performance. So we simply use the kind of quilt tool that's available on the platform, and then take the broad factor proxies and then rank them based on performance on an annual basis. And then we obviously update that 4 times a year at the end of each quarter. And coming into this most recent quarter, we saw 2 consecutive years where momentum was the top performing factor representatives there in that ranking. Which generally we don't tend to see things be best in back-to-back years. It's rare for something to be the best in back-to-back years, and value had been the worst performing area throughout the course of 2020, was second worst in 2019 and worse in 2018. So flip the script, we come into the first quarter of 2021, and now all of a sudden value has roared back to the top of the rankings with the broad value representative there, RPV from Invesco, showing a return of over 20% through the first 3 months of the year. So definitely pretty solid outperformance there. And the momentum representative, the DWA Momentum ETF with Invesco, ticker PDP, did underperform in the first quarter, with momentum going from the top down to the bottom at a loss of almost their 3%. So interesting to see it's most of the market, as you said, still kind of generally continuing to trend higher. But that strength is certainly broadened out over the course of the first 3 months of the year, John.
Yeah, I mean, value for sure. I mean, to put that in perspective, the S&P 500 was up about 6% in the first quarter. And so you see returns from, a lot of value areas up in double digits, and in that case, 20+%. I mean, the small cap similarly continued the outperformance that they began to see last year. The small cap performance trends carried into the first quarter of this year as well. And so, as we move through the second quarter, we'll continue to monitor those things, but it's very probable that, as you're looking at portfolios and doing any kind of relative strength type of investing, there were quite a few changes that we saw take place. As a matter of fact, specific to that, in last week's podcast, we had a discussion around the technical leaders suite of indexes that we have that just went through their quarterly rebalance. So at the end of every quarter, those indexes rebalance, and we saw a ton of changes in there. Some of the highest changes that we've ever seen take place. So if you missed that one, be sure to go back and take a look at that technical leader podcast for discussion around those strategies. But with that said, it's as we step back and we look at the markets, we're looking at the markets from a lens of technical analysis of price momentum or relative strength in the markets, and really what that is all about is finding ways to uncover opportunities in the market. And there's very basically two main areas of analysis that you can have: technical analysis, which is going to focus on the price of securities, the price of individual stocks, and then the fundamentals of the companies. So looking at earnings, looking at revenues, looking at PE ratios, and all that kind of good stuff. And those are two very different ways to analyze securities. One is going to be more looking at the what we want to own from a company perspective, and that's the fundamentals. The other is going to look at the when we want to own that, and that is going to be the technical side of the equation. And oftentimes, some at very extreme points in the cycle, those two things don't always line up. You can have a situation where you have a good company, but the price of the stock of that company is not performing well. And there's a lot of examples that we've had. And Ian, I know you were just looking at one recently that shows a very big disconnect sometimes, not all the time, but certainly sometimes there's a very, very big disconnect between those two things.
Absolutely, and one example that we tend to use is GE. We'll looking throughout history, really, from the late 1990s, early 2000s. Through the kind of 2010 timeframe, and in looking at that particular, if you pull up that price chart, that just point and figure chart on the platform, and then overlay that with the revenue of GE, I think it presents a pretty powerful image to what you were just alluding to. That we actually saw the price for GE peak back in August of 2008, August 28th of 2000. Was when that price chart peaked on that point and figure chart that you can see on the platform. Whereas the revenue for GE peaked on December 31st, 2008. And so if you kind of look at those two line graphs, they certainly show quite different peaks, about that 8-year gap in the middle. And if you look at returns from the price peak through the revenue peak, you're looking at the time frame where the S&P did not have that great of in 8 years. They're down about 40%, but GE was down 72, almost 73% from August of 2000 to December of 2008 for that price peak to revenue peak. And I think that helped kind of visually portray what you were just looking at there, Jay, and taking it back to the broader conversation between whether you're looking at technical analysis or fundamental analysis. Obviously, we're, as you said, looking at things on the technical analysis side here, specifically with point and figure charting. But we can definitely see those areas a lot of times kind of used in tandem with some of the different screenings or availability that we have on the platform could pair in well with some of the other forms of analysis or rankings. But that's also not necessarily always going to be the case, especially when you get into the current state of things with earnings season coming up here, Jeff.
Yeah, another one of those phenomenons that happens, it comes around every quarter, is earnings season in the market as companies are coming out and reporting earnings. And there's a lot of interest around those earnings, what those numbers look like, and then not only the earnings themselves, but the forecast. As you mentioned, though, in the case of GE specifically, I mean, it went through years of improved and increased revenue growth year after year for a solid 10 years or so there. Nonetheless, the price of the stock just kind of continuing to steadily plod lower. And so, that is a disconnect there. And from a revenue perspective, But on the earnings side, I mean, there can be very often times where, you know, a company will come out with great earnings and the stock is down for whatever reason might have been said, or vice versa. So there's always a lot of volatility, oftentimes a lot of volatility around the earnings and what those numbers and then subsequent guidance ends up being, at least in the short term. But how does that affect stocks over time? I mean, are earnings growth a big driver of performance trends that we see in the market?
So that's always a question that we tend to look at, especially this time of the year, as we into quarterly rebalance there, or a quarterly time frame in the market. But there's a pretty interesting article that we were talking about with before jumping on here, Jay, looking at essentially just that. Do earnings matter for stock returns, right? It was an article by Nicholas Rebenier and the CFA Institute blog that was essentially looking at taking trailing earnings and then forward earnings for securities and seeing how well those match up to returns from the S&P 500 index. Looking at the first iteration of that, looking at 5-year rolling returns for earnings growth, and then overlay that with U.S. stock returns from using the S&P 500 as a benchmark from around 1904 up and through the end of this test in 2020, February 2020. Looking specifically, they say, okay, just how well do they match up? If we have in a period of kind of prolonged earnings growth, does that tend to correlate pretty well to equity growth in the stock market or not? And while we definitely see periods throughout the time frame of that test where it did correspond pretty well. We did see earnings growth that tend to lead to growth in equity prices. At the end of the day, the correlation over the entire history of the test was only 0.2%. So it didn't really align all that well. We didn't necessarily see it make that much of a difference whether we were in a period of earnings growth or not quite as much growth, whereas the stock market kind of continued to generally trend higher, obviously with some setbacks, but generally moving higher throughout that time. The second, I think, other interesting study that he took a look at in this particular paper was looking at forward earnings. So essentially, if you were going to be the perfect market timer looking to go in and get into securities before a 12-month period of earnings growth, how does the stock market typically do from there? And the way that he looked at the data in this particular case, split it off into earnings growth percentiles. So you had 10 different percentiles of next 12-month earnings growth, and then overlaid that with annual S&P returns. And in looking at that, if you saw a significant earnings decline from a forward perspective, that did typically tend to correlate with lower returns for the S&P 500. But other than that, if you saw either muted earnings growth or significant earnings growth, the S&P continued to trend up about the same as it would have otherwise. So I thought that was a pretty interesting kind of third-party research to come in and say, I mean, at the end of the day, I mean, you could have. We've definitely seen it looking over the course of the past year, Jay, that you come in, you see positive earnings, looks like the stock's going to beat, but it's down 5% that day. Or maybe a stock that doesn't beat its earnings across the board, but you have positive forward guidance, and then you see the stock up 5% that day. So it can definitely be an especially interesting environment, and also a volatile environment for investors that we're getting into here.
Yeah, you're right. I mean, I'll certainly be paying very close attention to stocks that I own that have earnings coming up, as I'm sure everybody will, which this week, a lot of big financial names coming up. So, the first couple of weeks are always an interesting time to watch that. So we'll be, certainly be sure to pay attention to that and what's going on. But it is, I mean, what is happening with these earnings announcement is they are looking to see and report on what the company has done in the past, and as opposed to, that number really being very much forward looking in terms of the price of the stock. And at the end of the day, as investors, that's what we really care about is how is that stock performing within our portfolios. And so when we approach the markets from a different perspective of technical analysis, what we're doing is we're evaluating the price action of that security over time, and the price of that stock is taking into account the opinions and the votes, frankly, by all market participants out there. They're looking at, it's not one segment of the population. It's not just retail traders or just institutions. When you look at the price of a security, that is the general consensus of the market participants in terms of what they believe to be the fair price or fair value of that stock, given their expectations, whether that's growing earnings, whether it's growing revenues, and whatever that might be. And so we can evaluate these securities from a technical perspective in a very much objective manner. We utilize the point and figure method specifically, but at the end of the day, all technical analysis is looking at is the price performance of stocks over time, not only on an absolute basis, but in the case of whether it's a model portfolio or technical leaders index, as I mentioned, or something else, but not only just looking at the absolute price performance of those stocks, but also the relative performance of those stocks. How are those names that are within our portfolio performing relative to other things that we could potentially own? And that's a big component of it. But again, at the end of the day, it all comes down to price, and that price is going to be the biggest determinant of value for investors over time. And so that's where we focus our attention in terms of driving not only individual stock ideas and comments through our research platform, but also through various other relative strength portfolios or indexes that are out there in the marketplace. So with that said, earnings are certainly very, very important to investors. And, we do make an effort to at least make you aware and make it easy to find out which stocks are reporting soon. And Ian, what's a couple ways that someone who's utilizing our platform can stay on top of which stocks are set to report earnings coming up?
So the easiest way, probably, if you're taking a look at an individual security, right, you simply just type in the ticker in the upper right hand corner, you go to the chart page, and if you see a little red banner at the top of that chart page, it'll say stocks earnings are expected on a particular date. If the stock's expected to give earnings at some point in the next 30 days, you'll see that little red banner at the top of the page, just to let you know, hey, this is on the horizon, something to be aware of. If you want to see a list of all securities that are looking to give earnings within the next 30 days, you can use one of the database reports that we have on the platform, which is going to be found up top for those that are subscribers. You can go up top to security selection, security screener, and then database reports. And it's going to be one of those reports down there towards the bottom, stocks with earnings releases. And you can get a full list of securities with upcoming earnings releases broken out by their respective DWA groups, which I think can be pretty helpful to go in and take a look at as well, just to see, okay, which groups have a bunch of stocks reporting earnings in the next week or so, to go through and see what might be moving around a little bit more.
Yeah, that's right. No, it's always an interesting time of year in the market as earnings are coming up, especially as you're getting a lot of the big names out there reporting here this week and really over the next couple of weeks. So be careful out there, pay attention, but there's also a lot of the research, Ian, that you just referenced is, while there might be some short-term volatility around some of these stocks, the earnings side of the equation and the earnings growth are not necessarily designed to be predictive towards the overall performance of the stock over long periods of time. So certainly very, very interesting. Appreciate that discussion, and that research paper out there was pretty timely out there too. So thanks for the discussion, Ian. Thank you all for taking time out of your day to join us and listen to this on this podcast. If there's anything we can do to help you in your business, please do not hesitate to reach out to us. Email is dwa@dorseywright.com. Phone number is 804-320-8511. With that said, thank you again for joining us and look forward to talking to you next week.